With the market currently closed, SoFi Technologies, ticker SOFI, last traded at $25.24, marking a decrease of 2.83% during Friday's session, which concluded on October 3, 2025. The stock saw a day's range between $24.84 and $26.18. While a single day's decline might cause some immediate concern for those tracking their portfolios on platforms like Fidelity or Robinhood, the real story isn't about this minor fluctuation. The expectation for many is that SoFi is a volatile fintech play, heavily reliant on the sentiment around student loans and banking disruption. The reality, however, is that the company has quietly been making moves that fundamentally alter its risk profile and growth trajectory, something that daily chart watchers might be missing. Just recently, on October 2nd, SoFi announced the launch of Level 1 options trading on its platform. This isn't just another feature, it's a strategic move to capture a more sophisticated retail investor, increase user engagement, and create a stickier ecosystem, pulling traders away from competitors like interactive brokers. This development hints at a much broader ambition than simply refinancing student debt. The common belief surrounding SoFi stock is that it's a high beta name, a proxy for the health of the consumer and the ever-present debate over student loan forgiveness. For months, the narrative has been tethered to macroeconomic headlines and interest rate speculation. Investors, whether self-investing through a SoFi Invest account or using Schwab Intelligent Portfolios, have been conditioned to see SOFI as a binary bet on these external factors. But this perspective is becoming increasingly outdated. The deeper reality is that SoFi is executing a methodical transition into a full-fledged, diversified financial institution, and the market seems to be perpetually a step behind in recognizing the shift. Its recent performance, despite the latest session's dip, tells a story of resilience. Over the past year, the stock is up an astonishing 237%, showcasing a powerful underlying momentum that transcends the day-to-day noise. This isn't just speculative fervor, it's a reaction to tangible results and a rapidly expanding business model that is firing on all cylinders. The recent pullback from the 52-week high of $30.30 presents a fascinating study in market psychology, where short-term profit-taking might be obscuring a much more compelling long-term growth narrative. Looking at the recent trading dynamics, the volume on Friday was robust, with nearly 79 million shares changing hands. This indicates significant interest and participation, even on a down day. The intraday volatility, swinging from a low of $24.84 to a high over $26, shows that there's a tug-of-war between buyers who see value on the dips and sellers taking profits. This is the classic battleground for a growth stock. But let's look beyond one day. The past month has seen the stock gain over 9%, outperforming the broader finance sector. This divergence is critical. While traditional banks grapple with net interest margin compression and economic uncertainty, SoFi has been demonstrating impressive member and product growth. Its last earnings report for the second quarter of 2025 was a testament to this, with adjusted net revenue climbing 44% year-over-year to $858 million and adjusted net income skyrocketing 459% to $97 million. The company added a record 846,000 new members, bringing its total to 11.7 million. These aren't just numbers on a page, they represent a powerful and accelerating flywheel effect that many are underestimating. The expectation is fintech fragility, the reality is accelerating fundamental strength. The institutional activity provides another layer of confirmation. As of the latest filings, institutional ownership stands at a significant 59.07%. Big players like the Vanguard Group and BlackRock maintain substantial positions. More telling is the recent activity. Filings from June 2025 showed a notable increase in institutional buying. SquarePoint Ops LLC increased its stake by over 329%, and Goldman Sachs boosted its position by more than 150%. This isn't speculative hot money, this is the so-called smart money, making a calculated decision that SoFi's future is brighter than its present valuation suggests. While some firms like D.E. Shaw & Co. trim their positions, the net institutional inflow has been positive. This accumulation by major funds, often executed through platforms like interactive brokers, provides a strong vote of confidence in the company's long-term strategy and its ability to execute. They are looking past the daily chatter and focusing on the underlying business transformation. For those who are newer to the story, what does SoFi actually do? It began primarily as a student loan refinancing company, but that's a distant memory. Today, SoFi operates as a comprehensive digital personal finance company. Through a single app, which competes with offerings from Fidelity and SoFi's own SoFi Invest platform, members can manage their banking, borrowing, and investing needs. You can open a high-yield checking and savings account, take out a personal loan, secure a mortgage, trade stocks and ETFs, and now even trade options. This all-in-one financial services marketplace model is its key differentiator. The goal is to acquire a customer for one product and then cross-sell them multiple others, a strategy known as the financial services productivity loop. This increases the lifetime value of each member and creates high switching costs. Furthermore, SoFi holds a national bank charter, which it acquired in 2022. This is a crucial distinction from many of its fintech peers. It allows SoFi to hold deposits and make loans using its own balance sheet, which lowers its cost of capital and gives it more control over its product offerings. It's a neobank with the legitimacy and regulatory foundation of a traditional bank. a hybrid model that the market is still struggling to properly value. Its past performance has been a story of aggressive growth and a determined march towards consistent profitability. After years of investment and scaling, SoFi has now delivered consecutive quarters of positive net income, silencing many of the early skeptics who doubted its ability to translate user growth into bottom-line results. The second quarter 2025 earnings beat was significant, with an EPS of $0.08 exceeding the consensus estimate of $0.06 by 33%. This marked the fourth consecutive quarter that SoFi has beaten earnings expectations. This consistent outperformance is a powerful signal. It tells us that management is not only setting ambitious goals, but is also effectively executing its strategy. For investors considering an individual brokerage account to buy shares, this track record of execution should be a key data point. The narrative of a cash-burning fintech is being replaced by the reality of a profitable, high-growth financial institution. I want to hear from you. Comment below what percentage of your portfolio is allocated to fintech stocks like SoFi, the Tesla stock, the Apple stock, or the Nvidia stock. Looking ahead, the future for SoFi appears to be ripe with opportunity, but it is not without its risks. The expectation is that competition from legacy banks and fintech startups will erode its margins. The reality is that SoFi's integrated ecosystem and bank charter provide a significant competitive moat. The recent launch of options trading is just one example of its continuous innovation. The company is also restarting its crypto services and launching new investment products like the SoFi Agentic AI ETF, tapping into major growth trends. The potential for lower interest rates in the coming quarters could also provide a significant tailwind for its lending businesses, boosting both loan origination volumes and profitability. However, risks remain. A severe economic downturn could lead to an increase in loan delinquencies, impacting the company's financial performance. The regulatory landscape for financial technology is also constantly evolving, and any adverse changes could create headwinds. Furthermore, the stock trades at a high valuation with a forward PE ratio that is significantly above the industry average. This means that high expectations are already priced in, and any execution missteps could lead to a sharp correction. Investors using platforms like Robinhood, known for attracting a younger demographic interested in growth stories, need to be aware that this high valuation demands near flawless execution from SoFi's management. In conclusion, the narrative surrounding SoFi Technologies is at a critical inflection point. The market's expectation of a volatile student loan-dependent fintech is clashing with the emerging reality of a diversified, profitable, and rapidly growing financial powerhouse. The recent price action, including Friday's dip, is merely short-term noise within a powerful long-term uptrend supported by strong fundamentals, accelerating member growth, and savvy institutional buying. The company's strategic initiatives, from its bank charter to the expansion of its investment platform with features like options trading, are creating a formidable competitive advantage. While the valuation is demanding and economic risks are ever present, SoFi's consistent execution and clear path for future growth suggest that the reality of its potential may still far exceed the market's current expectations. The disconnect between the old story and the new reality is where the opportunity lies for discerning investors.